And now moving to climate challenges and the road to decarbonisation. And we are very fortunate to have Sarah Barker here to facilitate that panel. And I would like to personally thank Sarah for the commitment she's had to ASFI as well and to her organisation. And just what I've observed over the last few years is Sarah's not only passion, but her practical impact that she's having across Australia and globally on the debate, particularly around this topic of fiduciary duty that has come up over the last 2 days. But let me introduce Sarah. So she is the partner and head of climate risk governance, MinterEllison, and she leads the climate and sustainability risk governance team in Asia Pacific's largest commercial law firm, and is a director of one of Australia's largest superannuation funds, the Victorian State Government's $30 billion emergency service and state super. She has more than 2 decades experience as a corporate lawyer and is regarded as one of the world's foremost experts, and I've observed that firsthand. Sarah's leadership in the field of climate change related risk and liability is internationally recognised and has been called upon by institutions from the Bank of England to the United Nations PRI. Her clients include some of the world's largest diversified mining and resource companies, Australian and international banks, asset managers, government departments, treasury corporations, and statutory authorities. In her spare time, she also teaches as part of the Cambridge University's Institute for Sustainability Leadership, convened by EY, and is an academic visitor at the Smith School of Enterprise and the Environment at Oxford University. She is a member of ASFI, as I called out, and she's the only lawyer amongst a committee comprising senior executives from the Australian banking, finance and insurance sector and has made a substantial contribution. Sarah was also the instructing solicitor on the 2016 and 2019 briefs to Mr. Noel Hutley that was widely cited as the authoritative piece on directors' duties with regard to climate change risk, and has been referred to by APRA, ASIC and the Reserve Bank of Australia. So you can see the whole adage about give something to a busy person and it gets done is certainly with Sarah. And so Sarah, I'll hand over to you to introduce your panel and lead the next session. Thank you.
Thank you so much, Jackie. You can stay. And yet my children think that I actually don't know anything about anything. So maybe I'll get you over to read out the CV to them. Good afternoon, everyone. Thank you so much for attending this very significant conference on the SDGs today. I never find it a bad time to talk about SDG 13, climate action. But of course, today I think it's particularly timely given the extraordinary pace of developments that we're seeing in the climate space at the moment. So before I introduce you to our incredible panelists today, I thought it would be worth taking a few seconds just to go through some of those developments from recent weeks. Now, I don't like a laundry list, whether it's figuratively or literally, as you might ask my husband. But given how much has changed in the last few weeks, forgive me while I do run through some of those significant developments. First of all, on the policy and regulatory front, even just this week, we've seen the NGFS, the Network for Greening of Financial Services, which is the group of more than 80 central banks and prudential regulation authorities around the world, publish its second edition of its model scenarios for use by central banks and the entities that they regulate. Overnight, we've had the Bank of England commence its stress tests on UK banks. 2 weeks ago, we had President Biden release his executive order on climate-related financial risk. It is called the Executive Order on Climate-Related Financial Risk, in which he asks for reports back from his leading bureaucrats on the impact of a transition to a net zero economy on the US, how it's going to be financed, how they might need to shift the terms of government procurement to be consistent with only engaging with suppliers who themselves have an equivalent net zero policy. Here in Australia, we've had APRA released its draft consultation guide, draft consultation on prudential practice guide on the management of climate-related financial risk for financial entities in Australia. ASX announced an enforcement focus on greenwashing, and that's just all in the last couple of weeks on the policy and regulatory front. Let alone on the broader legal front, where we've had Noel Hutley release the 3rd edition of his seminal opinion series, where he basically says that it's now squarely part of a director's duty of due care and diligence to consider the impact of net zero on company strategy. We've had the Shell case in the Netherlands last week, in which Shell was held to found to have a duty of care to Dutch citizens to align its business strategy with the Paris Agreement, which included a policy to reduce emissions by 45% across all scopes by 2030. We've had the Sharma case here in Australia, where the Minister for the Environment was found to have a duty of care to Australian children that to protect their health from climate-related impacts, and take that into account when approving the extension of a thermal coal mine in New South Wales, let alone what many have referred to as Black Wednesday last week, where 3 activist investors were elected to, or director nominees of an activist investor, Engine Number 1, were elected to the Exxon board. A majority of Chevron shareholders voted to require them to publish Scope 3 emission reduction plans. And of course, the IEA's bombshell net zero emissions roadmap, which is the IEA's outlook for, well, what may a transition to net zero look like across many commodities markets if we are to maintain global warming below 1.5 degrees. So it's just extraordinary things that have developed in the last few weeks. And those of us who do practice in climate change full-time find it difficult to keep up. So let alone those of you who have other aspects to your portfolios that you need to manage. So the task for us today is to basically simmer it all down for you to the so what. What does it mean? And in short, it basically means that having a net zero target has become a ticket to play for your customers, for your suppliers, for your investors. The issue now then, having such a target, is, well, how the hell do we get there? What does a credible plan for getting there look like? And it's that how that certainly I'm finding that my clients are now struggling with. And so we are very, very lucky today to have 3 of Australia's leading climate change practitioners with us to share their insights into the how, and not just in terms of managing climate-related risk, but given that almost irresistible push towards net zero, also looking at the opportunity. So it's my absolute pleasure to briefly introduce Tim Buckley, who is the Director of Energy and Finance Studies at IEFA, the Institute for Energy Economics and Financial Analysis. And Tim, of course, has more than 30 years experience as an analyst in the energy space. We have Chris Newton, who's the Executive Director of Responsible Investment at IFM, large infrastructure investor. And then finally, from the corporate point of view, we have Dr. Fiona Wild, who is the Vice President of Sustainability and Climate Change at BHP, and of course, a member of the task force in the Task Force on Climate-Related Financial Disclosures. So thank you all so much for being here today to share your insights. Tim, if I may, I might start with you, just to set the scene a little bit, to talk to us about the science and economics behind the net zero trajectory. What shifts need to occur, and not just in coal and oil and gas that we talk about all the time, but what are the shifts that you see occurring in markets and that need to occur further in Australia?
Thanks, Sarah. And I think that's a great summary. I mean, what I really take out of what you just said, the extraordinary pace of change that we've seen in the last 6 months is just staggering. And as you say, we work full time in this area and we can't read it all. How the average practitioner keeps up to speed is almost impossible. But it's a wonderful, positive trend. And I say that we've been waiting for a decade for this sort of magnitude of groundswell of shifting in governments, corporates, financiers, communities, all coming together globally. And who knows, even Australia might join in. And I'll come back to that comment in a minute with a very positive trend out of New South Wales overnight. So firstly, net zero emissions, it is an extraordinary pace of change. To me, the biggest example of that, a year ago, we were talking about the almost impossibility of 2 degrees. Like the trajectory was 2.8, 3 degrees, depending on which scientist you talk to. The more realistic ones were talking north of 3 degrees. Financial communities worldwide, corporates worldwide have shifted the gear enormously and are now referencing 1.5 degrees. Now, that is a profound shift in the last 6 months. And I say that because the remaining global carbon budget comes down by 60% purely because of that shift. And yet when you look at things like the Glasgow Net Zero Owners Alliance commitment, it doesn't even mention 2, it says 1.5 degrees. The second aspect of what I found really important in the shift a month ago in the Glasgow Net Zero Owners Alliance, the Glasgow Net Zero Banking Alliance, the Glasgow Net Zero Insurers Alliance, so 3 very, very key alliances that Mark Carney announced, they all talk about both the, beyond the horizon 2050 targets, aspirational, that's someone else's problem. The net zero shift now is all about 2030 interim targets. It's all about annual transparency and accountability. And so that to me is a profound shift. The second one, I'll pick up on the point you made. It's a profound shift from the International Energy Agency as well. Right? For a decade, I've been fighting with the IEA. Now I totally endorse their latest roadmap. It is spot on because it doesn't bother hedging. It doesn't talk about let's have an unlivable planet and talk about what the energy system will look like. It talks about, well, okay, we have to have a livable planet. How do we achieve that? And they come up with a pretty core conclusion, which is very pertinent to every investor and every politician in Australia. And that is the world can no longer develop any new unabated coal, oil or gas project. No hedging, full stop. Now, that's a profound shift again, because a year ago, we were hearing from global financial leaders, they're all introducing coal exit policies. Fast forward to today, they're talking about the net zero emissions pledges. They're talking about the comprehensive implications to reduce systematically their exposure to fossil fuels in aggregate. And so I think the whole language has changed, the target, the ambition, and I love the global competitiveness that's come out of Korea, Japan, China. You mentioned President Biden, what a breath of fresh air from America. That's just lifted the aspiration even more. So, and Europe, of course, doing the heavy lifting for a decade. So it's a global shift and Australia will have to play.
Thank you, Tim. It's interesting that you talk so much about the different global alliances on net zero. There's the asset owners, there's the insurers, there's the asset managers, which is a great segue across to Chris, because of course IFM is involved in the Global Net Zero Asset Managers Initiative. Perhaps from an investor's perspective, you could talk to us about that initiative, but also from an opportunity point of view, the opportunities that IFM is seeing open up to investment for it as a result of the shift towards net zero.
Thanks, Sarah, and good afternoon, good morning, everyone. I'm joining you from the Whadjuk Noongar area of Perth in Western Australia, so pay my respects to their elders past, present and future. It's Tim's spot on, and what you were saying just then, one thing we've really noticed over the last few months, and just reflecting on something Tim said as well, updating our models. 2 years ago, we had a 2-degree model in our physical and in our transition risk assessment. And today, you know, we have to, and we are increasing those models to 1.5. So it's an awesome thing. But the other big thing we're noticing as well is this idea about two elements area is collaboration and cooperation amongst asset managers, asset owners. Exactly what we were saying. It's unbelievable, the intensity in terms of these collaborative networks from Climate Action 100 in the equities markets. That's been going on for a few years now, and some great actions and outcomes now. The Net Zero Asset Managers Alliance, which you mentioned before, and IFM were one of the first members of that organisation, set up late last year. And that is a commitment to 1.5 degree. It is a commitment to have 5-year reviews of the portfolio. And it's also a commitment to be transparent as possible as well. One of the first part of it is actually about partnership and actually working with asset owners, recognising that asset managers are just one part of the solution, but it needs a collaborative effort. The other part that's, you know, important to note out for the net zero asset, it's now up to, I think, 37 trillion under management. I'll get the numbers right, 87 signatories. So some of the biggest fund managers in the world are participating in it. It is just at the moment, just for portions of where there is direct control or influence from the fund managers. So it's not their entire FUM. But that's the next part, and that's why the relationships with the asset owners is really important to think about. And the other part of your question as well around opportunity. So really that's manifesting in two ways for us and for all managers really. It's around the allocations towards renewables and new tech, the supply chain aspects, allocation of capital, and it's also around the abatement, so setting the targets ourselves. As you know, we've set emission-based science-based targets for our Australian portfolio, doing that for the global portfolio. Later this year, we'll have an interim target for 2030 across our global infrastructure portfolio as well. The reality is that a lot of the renewable focused projects are not, it's competitive, so the returns are relatively low in the scheme of things. They're still positive, of course, but it's made a change and shift of asset managers looking at innovative ideas and building platforms and investing in early stage technologies and early stage development, which is actually what we need to confront the climate challenge. I'll stop there because I can talk underwater on climate as well, and I'm really conscious that Fiona's next in line, who's obviously a leading thinker in this space, as is BHP.
Thanks, Chris. Well, speaking of infrastructure, where the rubber hits the road, see what I did there. It's wonderful to have a company who is leading in this space in terms of the transition to a low carbon economy, and in the form of BHP. Now, Fiona, you do have a net zero target, operational net zero by 2050. Can you share with us how BHP plans on getting there, but also working for such a large, diversified extractives company? How do you do that work that you need to do strategically internally to convince all your internal stakeholders that this is a shift that needs to happen?
Yeah, great question. And thanks very much for the opportunity to join you today. We do have operational emissions targets at BHP. We've been setting them since, I think, about the mid-1990s, but over the last few years, so since about 2017, we've actually moved from having what you might call short-term targets that were set every 5 years to having short, medium, and long-term targets. And that's been really helpful for the organisation in terms of how we address near-term actions that we need to take, but also to provide a really clear line of sight to our employees and our investors about the decarbonisation trajectory for the company. So we do have a current short-term target to keep our emissions flat at 2017 levels by 2022. We then have what we call a medium-term target to reduce our operational emissions by 30% by 2030. And then we have a long-term target to get to net zero by 2050. When we look across BHP's emissions, so BHP's operational emissions, so scope 1 and scope 2, They come up to about 16 million tonnes, and they come predominantly from 3 areas. The first thing is electricity, the second is from diesel combustion, and the third thing is from fugitive methane, largely from open cut mining. So when we think about addressing those emissions, it's really about, first of all, shifting across to renewables, and that can be through PPAs, through contracts, or it can be through behind the meter installation. It's about displacing diesel for mass material movement. So thinking about alternatives to the trucks that we use, that could be through alternative fuels, it could be through electrification, or through different types of movement. So for example, trolley assisted movement or in-pit crush and conveying technologies. And for fugitive methane capture, we really need to look at research and development to improve that area in particular. So once we understand what the emissions profile looks like for the company, we then need to determine what our pathway to net zero is. So over the last 2 to 3 years, we've developed a pathway to net zero for the company. And underpinning that pathway for the company is an asset decarbonisation plan for every single asset across BHP. Not all assets can decarbonise at the same rate. Assets won't use the same types of technologies or solutions. So we need to understand how we can take that corporate commitment and actually translate it into actions on the ground across the assets. So each of those assets has a decarbonisation plan, and our performance against those plans is directly tied back into executive remuneration, which is a really, really good way of driving action. So when it comes to your question about how do you convince internal stakeholders that this is about, this work is important and needs to be achieved, and that there's opportunities there, I find often tying it to exec rem is a really good focusing tool. The other thing I would say is it's really important to think broadly about climate change. So if you think about climate in terms of both the impacts of a changing climate, but also the societal response to that, it enables people to start thinking about risks and opportunities and what it means to them in their role. There isn't yet a role in BHP that I have identified where there isn't some kind of overlap of interest between the impacts of climate change or the societal response to it and an individual's job. Regardless of which asset they work in, which function they work in, there will be some sort of overlap of interest. And it's mainly a reflection of the fact that climate change is a really pervasive risk. It's like, I always think about it as like a volume knob that turns risks up to 11. And so any risk that you're exposed to, or potentially many opportunities you can see, will be amplified by climate. And that's really where you can gain people's interest and traction. The second thing I would highlight is the importance of certain tools to really help people think through risks and opportunities. And the one that comes to mind for me, and one that I've pushed really hard through my work on the task force on climate-related financial disclosures, is scenario analysis. The beauty, if you like, of scenario analysis is it helps you to think through how climate change can impact your strategy and investment decision making. And using this technique really allows companies to determine the risks and opportunities to which they may be exposed, the indicators that will show them that those risks and opportunities are coming towards them, and importantly, the action that they need to take to mitigate those risks or capture those opportunities. So using that scenario analysis tool is a great way to convince people that they need to get involved in this work and start to mitigate those risks or bring those opportunities to life.
Thank you, Fiona. And I can see that we're starting to get some questions through in the Q&A. Please keep those coming through. I have another question for the panel, and then we're going to open it up to your questions. Talking about strategy and the shift to decarbonisation and to net zero, one of the barriers that commonly my clients raise with me is the fact that they perceive an inconsistency between what they see happening in global markets and what our federal policy settings are. One of the comments I heard recently from VW about Australia's policy on electric vehicles, for example, was it's at best indifferent and at worst counterproductive. So I wanted to ask you, Tim, can you tell us your observations on that perceived disconnect between federal energy policy and the shifts that we're seeing in markets overseas?
Yes, you're being very polite there and dumping on your colleague from VW, but I think it's absolutely spot on. There's a massive disconnect here. Now, maybe to talk about the global disconnect and the idea that, I mean, go back 5 years ago, India was considered to be the big growth market for coal in the world. Now, in December 2020, solar tariffs in India dropped 20% year on year. And new solar is now cheaper than the fuel cost of running an existing domestic coal-fired power plant in India. So the phrase Kodak moment is spot on, because overnight that meant every coal-fired power plant in India, every existing coal-fired power plant in India is commercially challenged by solar. So the fuel cost, you literally can't afford to buy the coal to run your coal plant. You'll never get a return on your investment. You can't pay your interest and you will go bankrupt in the long term. So that's a market where no one talks about coal exit in India because their demand for energy is going to double or treble over the next 20, 30 years, and they need everything. But all of a sudden, new coal-fired power plants are unbankable. Now, the Australian market and the Australian government has been talking about exporting and the massive opportunity for coal in India for Australian companies. Well, that's just evaporated, right? It's totally gone. There is no market there for thermal coal. Another one, and again, to contrast the federal policy disconnect with the states, I would openly call out the state governments of Australia as showing clear government leadership. And I mean, even just having a read of the New South Wales Treasury intergenerational plan, which came out this week, and it's a profound change versus 5 years ago. 5 years ago, the New South Wales government's 40-year plan was that coal volume growth would be onwards and upwards every year for the next 40 years. Now, the intergenerational report says employment in the coal industry in New South Wales is either going to drop 50%, 75%, or 100% in the next 2 decades. Let's have a plan. And so the Treasurer of New South Wales is now formally on the record this week. Let's avoid a costly, slow, and disorderly transition. It is inevitable. We've got the trajectory right. We've got the direction right. Which of those 3 scenarios, it doesn't matter. We can at least start to have a sensible discussion. And I would contrast that to the New South Wales government peers in Canberra, who are yet to even acknowledge the science of climate change, yet to acknowledge that we actually need a roadmap, we need a destination, we need a time frame, and we need to get on with it, because Australia is the lucky country. We are blessed with opportunities, as Fiona and Chris have mentioned. Let's embrace the opportunities for investment, employment, export, and a more sustainable planet.
And certainly opportunities to invest in infrastructure are going to be music to Chris's ears. Chris, with all of that, how would you rate the sophistication of Australian proponents of infrastructure projects on taking climate risk into account on a forward-looking basis? Is it pulling teeth for you, or do you find that actually the markets are shifting?
Yeah, thanks, Sarah. And just before I get to that, I was just going to, if I'm on risky territory commenting on what Tim said, because he's made some really good points. But, you know, the allocation of capital in New South Wales for us is actually happening right now when we've got a good policy setting for Ausgrid. You know, they're getting the incentives right, and we're investing into community batteries at one of our assets. So it's actually working when the policy settings are right. An acquisition we're looking at in Europe, we get comfort around the policy settings in Spain because they're so committed to the net zero target and Paris, etc. Equally, transitioning one of our assets in Poland, which is a bit of a, you know, they've got similar challenges to Australia, let's call them challenges, but we know that's the agenda. We need government to sit alongside us in Poland to transition our assets, to help us create a better future, but also protect our returns for our investors. So the policy settings are critical for future long-term success globally. And there are examples in Australia where it's actually driving the allocation of capital, which is great. Just really thinking about that question about the sophistication of investors. infrastructure investors. It's a tough one to sort of scan across the market because it is a really wide spectrum in terms of the sophistication. And as we've mentioned before, the pace of change has just been phenomenal in the last 6 months alone. And perhaps I'd sort of think about that, the coalition. So the Institutional Investor Group on Climate Change, which is the one out of the UK, have been running the Paris-aligned investment groups. And what they've done last year is they set up a framework around net zero frameworks for predominantly equities, some sovereign bonds, some real estate, and so on. And this year for infrastructure, they've set up the same focus group, which is creating a framework for all infrastructure investors or real asset investors to utilize. So it's a common form of language, a common part where asset owners, superannuation funds, pension funds, etc., around the world can assess the performance of asset managers and making sure that what they are doing in terms of their due diligence process, in terms of their stewardship of privately held infrastructure assets, are aligned to zero. So I think that's a really critical part, that and reflecting on that collaboration. So the sophistication has increased immeasurably, but it's hard to keep up, as we mentioned. So that being part of these groups and cross-learning and sharing actually is going to be really critical. And that does actually mean that many of us in the financial services sector actually have to potentially give up some degree of competitive advantage, or alternatively at least leverage each other's, because it is a genuine thing around protecting, if not just identifying opportunities as well. I'll leave it there. Like I said, having people like the IEA be not grey anymore, just being very specific, is actually really critical for asset managers as well when they're looking at infrastructure too, because there's no other alternative. That's the bottom line.
Just one last question before we go to everyone else's questions. Fiona, one of the issues that's really been brought into focus in the last week, particularly with the Chevron vote and the Shell case, is all around Scope 3, so emissions outside business fence lines. Now, obviously, if you're not in control of what goes on outside your business fence lines, that can obviously be a challenge. But what opportunities do you see for that accelerated decarbonisation across a value chain? And how do you get that kind of industry-wide commitment, as Chris was mentioning in the investor context, to make some of the shifts that are needed?
It is a really, really challenging area, and I spend a lot of time thinking about this. And as you say, it comes down to this issue of operational control versus influence, and what can organisations do. It also depends where your value chain emissions or Scope 3 emissions come from. So for some companies, their emissions come from upstream, in other words, from their purchasing of goods and services from suppliers. For other companies, their value chain emissions come from downstream. So for example, from the processing and use of their products. And where you sit in that value chain dictates the level of control or influence you may have over those emissions. So unlike many other companies, 95% of BHP's Scope 3 emissions come from downstream of our operations. So in other words, from our customers' processing and use of our products. And that is very different to having those Scope 3 emissions upstream, where you can determine to a large extent who you purchase goods and services from and set conditions around the sorts of goods and services that you want to procure. So a couple of years ago, we've been reporting our Scope 3 emissions since, I think, about 2015. A couple of years ago, we decided we were going to go further, and we were going to acknowledge our role in supporting decarbonisation in our value chain, which for some in our sector hasn't been an area they've been kind of willing to tread. But we thought it was really important to kind of set out our stall and acknowledge that we have a role to play in supporting sectoral decarbonisation. But also there is carbon risk for BHP from being part of these value chains. So it's in our best interests to engage with our customers to enable them to utilise our products in a way that reduces emissions, because it reduces their footprint, but it also reduces our carbon risk. So when we think about that, we need to understand where our emissions come from, and we need to look at what our customers are choosing to do. So what are they aiming for? What are their Scope 1 and Scope 2 targets? and align our efforts with them, effectively enabling BHP to be like a catalyst for sectoral decarbonisation, I guess is the way I think about it. When we thought about which parts of our value chain to focus on, we wanted to focus on the activities that result in the most material Scope 3 emissions for us, which is steel making. So about 2/3 of our Scope 3 emissions come from our customers processing in use of iron ore and metallurgical coal for steel. And also those activities where we can exert more influence. And in our case, that's really around the maritime industry, because we're one of the world's largest charterers of ships. So it doesn't mean we don't look at all the other areas of Scope 3, but we really wanted to focus on where we have a material footprint and where we have more influence rather than less. It is really difficult to set absolute targets for Scope 3 emissions, particularly when they're downstream. The reason it's really hard is because Scope 3 accounting is not accurate nor precise. It's about using industry average emissions factors. There's a lot of double counting that goes on in the footprint. And that's, I mean, to be honest, that's the way that Scope 3 accounting protocols were designed. There's an inherent level of inaccuracy associated with Scope 3 accounting. But that's not a reason not to set goals and targets. It's just a reason to make sure people understand what activities you are undertaking and how you will measure your performance. So with us, what we've done is we've said, okay, we know that our customers want to achieve, for example, in the steelmaking sector, a 30% reduction in emissions intensity of steelmaking by 2030. So that goal is the goal that we've taken on for ourselves to support our customers to be able to achieve that goal. Then when it translates into what will we do, we need to set an action plan every year with really, really clear actions of what we're going to do and how that enables our customers to achieve that Scope 1 and 2 target for themselves. So for example, this year in our Scope 3 action plan, we set a target to establish 2 partnerships with very large steel makers, which would focus on how they can decarbonise their blast furnaces. And so far this year, we've actually developed 3 partnerships, which has been great. We've seen a massive shift in the level of interest in steelmakers over the last few years in this. So we now have a partnership with Baowu, which is China's largest steelmaker. We have a partnership with HBIS and a partnership with JFE in Japan. And what these partnerships are doing, they're investing money from BHP in projects that can actually enable our customers to reduce emissions when they're using iron ore and metallurgical coal in the blast furnace. And they're looking at ways that we can change those technologies over time to significantly reduce emissions through, for example, the introduction of hydrogen. It is a really complex area, as I say. It's an area we have to continually refine, continually adapt to work out what role we can play, and things will change in this space. But I think that the days are behind us of being able to say Scope 3 is not a problem that we should get involved with. This is about carbon risk in value chains, and it's also about the opportunities that we can take as a player in that value chain to actually catalyse sectoral decarbonisation. And that's absolutely where BHP sits.
Now, moving on to questions from our audience, and please do continue to send those through. Fiona, BHP is often referred to as the big Australian. And one of the themes in the question that we're having coming through is, particularly on Scope 3, you've got customers, you've got suppliers who, most of them won't be the same size as BHP. So do you have any insights, and this is a question without notice, so I do apologise for that. Do you have any insights on how BHP works across the value chain with smaller companies to assist them? And I might give you a couple of seconds to think about it. I'll let everyone, I'll let Tim and Chris know the questions I have from them that I'm drawing from the Q&A, and then come back to you. So Tim, the question that I'm seeing coming through that I will pose to you is on the CBAM, which is something else that another development that I didn't talk about, the Carbon Border Adjustment Mechanism, the details of which are due to be released by the EU on the 14th of July. So my question to you is going to be about the significance of the CBAM for the Australian economy, because I know that there have been some commentators who've suggested that it's nothing to see here for Australia because we don't export fertiliser, aluminium, cement or steel directly to Europe. So it would be interesting to get your insights on that. And Chris, my question for you is one that has come through from Paul Faraghi, basically on innovation in the energy sector. So Paul's question is about there's been a relative lack of runway or proof in investing in innovative energy projects like battery storage, like green hydrogen, renewable gas, which makes them look more risky. And so therefore finance is potentially an issue. So if you could provide comment on how you see how finance, whether it's equity or debt for these kinds of projects, might be unlocked going forwards. So back to the start of the circle, Fiona, smaller suppliers or customers in the industry,
Sure.
how do we assist them on their decarbonisation?
And thank you for giving me a moment to think about that. I would have probably given you a relatively similar answer, but I did have a brainwave while you were talking to Chris. So I appreciate the opportunity to look smarter as a result of the time that you gave me. What I would say generally is we do tend to target the biggest customers first. There's no doubt about that, because from my perspective, what I want to do is drive the biggest change possible. So I want to go to the biggest players because they tend to have the biggest footprint, but it also means they generally tend to have capital available to support reductions more quickly. So we do focus on our big players because we want to get a big bang for our buck when we're investing. You know, we're investing $50 million with Baowu from BHP. I want to get some value from that in the sense that I want to see emissions reduced quickly and at scale. But what we also do is we look for opportunities to work in partnership with others. So for example, we may have a partnership with Baowu, which is about directly investing in blast furnaces in, you know, with China's largest steelmaker. But we also join organisations like Responsible Steel, which have many, many more members, some of whom are nowhere near as large as Baowu. And the opportunity for us in joining those groups, those industry-wide groups or cross-collaborative industries, is it gives us the opportunity to share what we've learned with some of these bigger players, with smaller players, and really help that uptake travel more quickly through the sectors. The other thing I was just thinking about with the beauty of joining those sort of industry associations or collaborative groups is you also get some really nice cross-sectoral collaboration, which you often don't see. So we tend to kind of, you know, the mining industry players kind of understand each other, but sometimes find it quite hard to work with other players in different parts of the value chain. Responsible Steel, for example, brings together both the producers of the raw materials, the steel makers themselves, and increasingly the people who are utilising the steel at the end. And so bringing together all of those different players in the value chain actually gives us an opportunity to drive more action. The other thing I would just mention is, as well as thinking about those key customers, key markets where we can make a difference, we've developed a ventures business at BHP, and this is really looking at those early stage technologies that have a significant opportunity to reduce emissions at scale. And just in the last couple of years, invested in Carbon Engineering, which is a direct air capture firm based out of Canada, which is at the moment developing an opportunity to directly capture carbon dioxide from the air in the Permian Basin in the US, a 1 million tons a year plant they're looking at there. So this stuff is really starting to scale up, and as we know, is really crucial to getting to 1.5 degrees. And also Boston Metals is another one we've invested in, which is looking at different types of steel manufacturing, so molten oxide electrolysis. So it's not just about working with those large incumbent players, it's also about investing in those novel technologies and having that ventures business as a kind of seed funding for new ways that could reduce emissions at scale over time.
That's great, Fiona. I must admit, I always say to my smaller clients, you have a competitive advantage because you are agile and you are dynamic. And so this isn't just an area that's the province of the big players.
Exactly.
So Tim, CBAM, carbon border adjustment mechanism.
Yes, I think it's a really interesting and important, potentially global game changer, and there are plenty of game changers. But for Australia, for a little while, was a world leader. We had a domestic carbon price that got turfed out all too hard. Let's not lead, let's be a global laggard. The carbon border adjustment mechanism is the EU's attempt to say, well, for laggard countries, there will be a cost, and we are going to put in trade barriers to impose a cost on global laggards, global free riders. So I think the carbon border adjustment mechanism is likely for Europe by 2023. What I'm really asking about is America, Japan, and or China going to join it? And that to me is the huge game changer globally, because it goes from being an EU initiative. The EU's been leading the world for 20 years in this. They've got a price on carbon, it's 50 euros a tonne, and they've set the benchmark, but it's, do other regions replicate that? And I mentioned that, I mean, it's probably a low probability at this stage. I was talking last night to the Australian government about the complexity of America joining the carbon border adjustment mechanism without a carbon price of their own internally. It'll have huge implications, huge administrative burden on them. But at the end of the day, Biden wasn't elected on a carbon tax policy. So his administration quite openly talks about how carbon border adjustment mechanisms aren't a carbon tax, so we could actually go for that. So I think that'll be the big game changer. It's not, Europe will do it. It'll be complex. It'll have legal implications. They've got the framework in place. It's can and when do other countries join in on that? And the idea of China joining in, I mean, I consider China a world leader, not a laggard. And, you know, Australia tends to position, or it doesn't matter what Australia does, China's not doing enough. China is working really aggressively here. And one example of that is that China is adopting the EU taxonomy when it comes to carbon. And so they're working very, very closely with the EU. The one point of agreement that the US and China have at the moment is about the climate ambition. So I think the chance of the carbon border adjustment mechanism going global on a medium-term view is quite possible, but it also means that the inevitability of pricing in carbon, and it shows the stupidity of the Australian federal government's energy policy chaos, because having failed to get the revenues in Australia from a carbon price to actually fund the transition, we're now going to have those revenues go to a foreign government. So we will have a carbon price. There is no inevitability. There is an absolute inevitability to it. We have to decarbonise because we're a global economy, a globally exposed economy, and the carbon border adjustment mechanism means Europe will tax Australian exports that are high emissions. And maybe final point, it doesn't have immediate direct impact on a lot of our exports. As you said, they go to Asia rather than Europe, but it's about the whole supply chain for the industrial complex. It affects the entire supply chain globally, and Australia has supply chain consequences for every product. And so I think every Australian company has to address this issue. So I think it's a game changer.
Thanks, Tim. Chris, I'm going to throw you a little bit of a curveball. I know that I did throw a question to you about investing in innovation and energy technology, but there's been one that has been superstarred next to your name in the Q&A, so I'm going to have to respect the superstar. Where is the motivation for fossil fuel companies to report comprehensively on ESG issues, given that many investors, debt financiers have exclusions on financing fossil fuels anyway? So it's not going to help them attract investment or lower their cost of capital. What's your view on the utility of considering and reporting these risks if you are fundamentally in an industry that investors are not inclined to invest in the first place?
Thanks, Sarah. Actually, I was going to try and combine my answer to both questions in that very vein around, because the premise that reporting doesn't reduce your cost of capital is not true. It does. We've got a first-hand experience in our own infrastructure assets, that are privately held. So when they go to the debt markets, 40% of their time with the global debt market was convincing the companies that they had a good sustainability story. So just purely on transaction costs, and the banks priced their debt very aggressively because they had a good story about it. And they are exposed to climate change. It's an energy company that I'm talking about. So for the companies that are in fossil fuel areas, that transparency and reporting is actually really critical for investors to make a decision. Yes, For IFM, we own the index. We're always going to own a number of our stocks on there. But the flip side is, like I said, that debt capital markets, that is a little bit more fluid for us. And that the reason I was going to link the two around technology and emerging things and batteries and all these things, to get the bank financing, they've got to increase their appetite for risk. And one way of doing that is information. And they get more comfortable with the risk if they have information, and having illustrations from BHP, from other companies showing outcomes in terms of new technology and new investments, that will reduce their appetite or increase their appetite for risk and their ability to invest in it. Now, I know Jackie's just chimed onto the screen, so I know we're probably up on time, and I'm always loath to interrupt Jackie, who did refer to Spider-Man in her quotes at the very beginning. With great power comes great responsibility, and kudos to Jackie for that. And also I wanted to call out Fiona for referencing Spinal Tap. I'm so impressed with the reference to modern culture, so I have to work on mine. But anyway, Sarah, I'll hand back to you. Just had to say it. Just had to say it.
Thank you. And I, in turn, will, before handing back to Jackie, thank you so much, Chris and Tim and Fiona, for sharing your expertise with us today. I could listen to either any of you talk for 12 hours without drawing breath. So no doubt our audience has also taken a lot, even from the short amount of time that we've had with you. So thank you so much. Jackie, I think we're the final session for the day too, so I'll pass back to you to close.